Higher future inflation prospects have been the dominant theme of this quarter as the potential for a global synchronized economic recovery is now stuttering into sight. The UK is the focus of global attention, with 90% of all adults having had at least one vaccination and the highly transmissible COVID-19 Delta variant in circulation. All domestic restrictions were lifted on the 19th of July 2021, and the associated wave of infections has been manageable and begun to diminish towards the end of this reporting period. The next and perhaps final test will be schools returning in September, followed by colder weather increasing indoor contact. The UK is the leading global economy for vaccinations and is at high risk for COVID-19 infections due to the diversity and travel propensity of residents. If the UK demonstrates that COVID-19 can be effectively controlled, this will be seen positively for the many other global economies following a similar strategy. During the reporting period, the Investment Association IA Europe ex-UK sector returned 4.49%, closely followed by the IA North America and IA UK gilt sectors, which returned 3.99% and 3.97% respectively. The IA UK All Companies sector returned 2.68% and the IA Sterling Corporate Bond sector returned 2.25%. The only mainstream sector to fall in value was the IA Asia Pacific ex-Japan sector, which fell by 4.94% due to concerns about China's approach to regulating technology companies. Since the 2008-2009 financial crisis and use of printed money by central banks, the concern has been that eventually increasing the supply of money in circulation would prove to be inflationary. When the scale of the COVID-19 crisis became evident last year, central banks again hit print in order to preserve economies in stasis and protect against the financial consequences of lockdowns. Transitory has been the buzzword when it comes to inflation. Jerome Powell has consistently sought to reassure investors that the pressures currently impacting inflation will equalize as the impact of COVID-19 on supply chains lessens. This terminology has spread to other central banks, with Andrew Bailey similarly expecting UK inflation not to persist. Central banks are navigating choppy waters, under pressure to keep borrowing costs low to allow historically high debt accumulation costs to be serviced, while hitherto unknown amounts of cash have been pumped into economies. So far, they are all holding the tiller steady, and markets are broadly convinced of their interpretation, with 72% of fund managers in June's Bank of America survey agreeing that they expect inflationary pressure to drop off next year. The question for investors is how permanent will these inflationary pressures prove to be? Many businesses will see the chance to make up for lost profits by increasing prices. And with many households still holding on to savings forced upon them by the reduced ability to consume, there will be demand despite higher prices. The Chinese government showed their hand in July, highlighting the significant political risk that investors must factor into their asset allocation. Chinese online tutoring companies, many of which had raised capital in US markets, found themselves overnight forced to become non-profit companies and were not allowed to raise capital from overseas. 3 of the prominent companies in the industry listed in the US saw their share prices more than half in one day as the news of the Chinese government's intentions leaked. Tencent also suffered sharp sell-offs in July on regulatory concerns and has now fallen circa 40% from the start of the year. Its flagship WeChat platform has suspended new user registrations in order to align with new government regulations, intended to improve data security and market stability. The fallout from this political intervention has now seen Chinese equities lose all the ground that they made in terms of outperformance against other markets since the start of the COVID-19 pandemic. The G7 agreed a proposal that would see revenue taxed in the location it arises, rather than where profits are declared, with a minimum of 15%. 130 countries and jurisdictions, covering 90% of world GDP, have agreed to the plan in principle. The Republic of Ireland is one of the notable holdouts, as their corporate tax rate of 12.5% has attracted many businesses to set up European headquarters through which to declare tax. This development represents one of 2 elements that we have long argued would become headwinds for high-flying tech companies, along with increased regulatory scrutiny. The period from the 2008-2009 credit crisis to the present has been a period of strong investment returns with mediocre global economic performance. A substantial element of the returns achieved have been due to lower interest rates creating capital inflation. The next cycle is expected to reverse this condition, with stronger economic growth leading to higher consumer inflation, higher interest rates and therefore lower overall returns for global indices but opportunities for active managers. Performance has been positive over the past 3 months, with each of the future money portfolios benefiting from the continued global economic recovery. While countries' reopening has been a positive, inflation is increasingly an area of concern for markets, and this prevented further gains from being achieved over the reporting period. Over the past 12 months, future money real value grew by 10.39%, real growth by 14.9%, dynamic growth by 16.68%, and future money income grew by 15.4%. Since inception in December 2008, real value has achieved an average annual return of 4.89%, while its target benchmark has delivered 2.08% annualized. Real growth has returned 6.25% against 3.1%, dynamic growth 7.53% against 5.14%, and income has delivered an annualized 6.45%, while its target benchmark has returned 3.1%.